Investing can feel like a complex maze. With thousands of stocks and bonds to choose from, it's easy to feel overwhelmed. Where do you even start? It's a common challenge for anyone looking to grow their money. But what if there was a simpler way? A way to invest in the whole market instead of trying to pick individual winners. This is where powerful tools like index funds and ETFs come into play for savvy investors. These two investment types have revolutionized how people build wealth. They offer diversification and simplicity, but they aren't exactly the same. Understanding their key differences is crucial for making the right choice for your portfolio. Think of them as two different kinds of shopping baskets. Both baskets are designed to hold a wide variety of items, representing different stocks, but you purchase and carry them in slightly different ways. In this video, we'll break down exactly what an index fund is, what an ETF is, and compare them side by side. No jargon, just simple explanations to help you understand these fundamental investment vehicles. Our goal is to give you the clarity you need to decide which basket fits your investing style. Are you a set-it-and-forget-it investor, or do you prefer more flexibility and control over your purchases? By the end of this short explainer, you'll be able to confidently tell the difference between an index fund and an ETF. You'll know the pros and cons of each, empowering your financial journey. So, let's start with the classic, the original way to passively invest in the market, the index fund. What is it, and how does it actually work? Let's dive in and find out more. First up, the index fund. Imagine you want to buy a small piece of every company in a major market index, like the S&P 500. Buying all 500 stocks individually would be incredibly expensive and complicated. An index fund solves this problem. It's a single fund that buys and holds all the stocks in a specific index for you. It's like a pre-packaged basket containing all the items on a very long shopping list. For example, an S&P 500 index fund owns shares in all 500 of the largest US companies. When you invest in the fund, you own a tiny slice of every single one of those companies. This provides instant diversification. Instead of betting on one company to succeed, you're betting on the overall health and growth of the entire market. This strategy significantly reduces your risk compared to single stock picking. The fund is passively managed. This means there isn't a team of analysts actively trying to pick winning stocks. The fund simply mirrors the index it tracks, which helps to keep the management fees very low. So, when you hear index fund, think automatic diversification. It's a simple, low-cost way to own a broad slice of the market without having to do all the research and buying yourself. It's a foundational concept. The goal isn't to beat the market, but rather to be the market. By matching the market's performance, investors can capture its long-term growth potential in a reliable and predictable way over many years. But how do you actually buy and sell these funds? The mechanics of trading an index fund are a key point of difference, and it's what we will cover in the very next scene. When you decide to invest in a traditional index fund, your transaction doesn't happen instantly. You place your order during the day, but it's not executed until after the stock market closes for business. All buy and sell orders for that day are bundled together. After the market closes, the fund calculates its final price for the day, known as the net asset value, or NAV. This is the price everyone gets. This means that everyone who bought or sold the fund on that specific day gets the exact same price. It doesn't matter if you placed your order at 10 a.m. or 3 p.m. The price is set only once. This once-a-day pricing is perfect for long-term buy-and-hold investors. They aren't concerned with small price swings during the day. They are focused on accumulating shares over months and years at a fair end-of-day value. You typically buy these funds directly from the investment company that offers them, like Vanguard or Fidelity. The process is straightforward, but it lacks the real-time nature of trading individual stocks on an exchange. Because of this structure, you can't, for example, place an order to buy only if the price drops to a certain level during the day. You simply commit to buying at whatever the closing price happens to be. This simplicity is a feature, not a bug. It discourages rapid, emotional trading and encourages a disciplined, long-term approach to investing, which is often more successful. Keep this trading style in mind. Now, let's introduce the modern alternative, the exchange-traded fund, or ETF. It takes the basket concept of an index fund and adds a major twist that changes how it's traded. Now, let's talk about the ETF, or exchange-traded fund. At its core, an ETF is very similar to an index fund. It's also a basket of investments, like stocks or bonds, that tracks a specific index. Just like an index fund, an ETF offers instant diversification. By buying one share of an S&P 500 ETF, you gain ownership in all 500 companies, spreading your risk across the entire market. This means ETFs also benefit from being passively managed. They aim to match the performance of their benchmark index, not to outperform it. This again leads to very low operating costs and fees for investors. So if they hold the same things and have the same goal, what's the big difference? The clue is in the name, exchange traded. This is the revolutionary part that changes everything about how they operate. Unlike a traditional index fund, which you buy from the fund company, an ETF is listed on a stock exchange. You can buy and sell it throughout the day, just like you would with a share of stock. This means its price isn't set just once at the end of the day. The price of an ETF fluctuates constantly from the moment the market opens until the moment it closes, based on supply and demand. This trading flexibility is the single biggest distinction between ETFs and index funds. It opens up different strategies and options for investors who want more control over the price at which they buy or sell. Let's explore exactly how this real-time trading works and what it means for you as an investor. The ability to trade all day has some significant implications for your investment strategy and overall portfolio management. Because ETFs trade on an exchange, you buy and sell them through a brokerage account, the same way you'd buy a share of any public company. The process is identical and familiar to most stock investors. As we mentioned, their prices change throughout the day. If the market is having a good morning, the price of your ETF will likely rise. If there's a dip in the afternoon, the price will fall with it. This allows for more advanced trading strategies. For instance, you can place a limit order to automatically buy an ETF only if its price drops to a specific level you've set, giving you more price control. You can also place a stop-loss order to automatically sell your shares if the price falls below a certain point, helping you manage potential downsides and protect your capital from significant market downturns. This intraday liquidity is a major advantage for active traders who want to react quickly to market news or economic data. They don't have to wait until the end of the day to adjust their positions. However, for long-term investors, this feature can be a double-edged sword. The ability to trade constantly can tempt people into making emotional, short-term decisions that may harm their long-term returns if not managed properly. Unlike many index funds, you can purchase as little as one share of an ETF. This makes them incredibly accessible, as you don't need a large lump sum to get started with a diversified portfolio. So, we have two similar products with one massive difference in how they're traded. Let's put them head-to-head and clearly summarize the key differences to make the choice between them even easier to understand. Let's summarize the biggest difference: trading. Index funds are priced and traded only once per day after the market closes. All transactions happen at that single net asset value, or NAV. In contrast, ETFs trade continuously throughout the day on a stock exchange, just like a stock. Their price fluctuates from moment to moment based on buying and selling pressure in the market. This means with an index fund, you get simplicity and are discouraged from timing the market. You accept the end-of-day price, which is ideal for a disciplined, long-term, set-it-and-forget-it investment strategy. With an ETF, you get flexibility and control. You can react to market movements instantly and use advanced order types to manage your entry and exit points with much greater precision throughout the day. Think about transparency. With an ETF, you see the price in real time. You know exactly what you'll pay or receive when you place your order. There are no surprises at the end of the day. With an index fund, you place your order blind. You won't know the exact price you paid until after the market closes and the fund calculates its NAV. You trust you are getting a fair aggregate price. This single difference in trading mechanism is the most important factor to consider. It directly impacts how you interact with your investment and what kind of strategies you can employ in your portfolio. But trading isn't the only difference. There are also important distinctions when it comes to costs and the minimum amount of money you need to get started. Let's look at those next. Let's talk about costs. Both index funds and ETFs are famous for their low fees, especially compared to actively managed funds. This is a huge advantage for both, but there can be subtle differences. The main fee is the expense ratio, which is the annual cost of operating the fund. Historically, ETFs often have slightly lower expense ratios than their equivalent index fund counterparts, but this gap is narrowing. However, when you trade ETFs, you may have to pay a brokerage commission, just like when trading stocks. While many brokers now offer commission-free trading, it's still a potential cost to be aware of. Traditional index funds, when bought directly from the provider, typically do not have brokerage commissions. This can make them cheaper for investors who plan to make regular, frequent contributions to their accounts over time. A more significant difference is the minimum investment. Many index funds require a substantial initial deposit, often $1,000 or more. This can be a barrier for new investors with limited capital. ETFs, on the other hand, have no investment minimum. The minimum is simply the price of one share, which could be $50, $100, or a few $100s. This makes them highly accessible. This low barrier to entry is a key reason for the explosion in popularity of ETFs. Anyone with a brokerage account can start building a diversified portfolio with a very small amount of money. So, we've covered trading, costs, and minimums. Now for the final question. With all this information, which one is the right choice for you and your financial goals? Let's conclude and find out. So, index fund versus ETF. Which one should you choose? The best answer depends entirely on your personal investing style and your long-term goals. There is no single, correct answer for every single person. If you are a long-term, buy-and-hold investor who wants to make automatic, regular contributions and not be tempted by daily market noise, the traditional index fund is an excellent and disciplined choice. Its once-a-day trading structure removes the temptation to overtrade. It's perfect for the set-it-and-forget-it philosophy, allowing you to build wealth steadily without daily portfolio management or stress. On the other hand, if you want more flexibility, lower investment minimums, and the ability to trade during the day, the ETF is likely the better fit for your needs. It offers superior control. ETFs are ideal for investors who want to start with a small amount of money, or for those who want to use more active strategies, like setting specific entry and exit price points for their investments. Ultimately, both are fantastic, low-cost tools for building a diversified portfolio. The differences are more about the wrapper and how you access the investment than the underlying assets themselves. You can't go wrong with either. Many modern investors use a combination of both. They might use index funds for their core retirement savings and use ETFs for more tactical or specialized investments in their portfolio. It's a hybrid approach. We hope this clears up the confusion between these two powerful investment options. Understanding these tools is a huge step toward taking control of your financial future. Thanks for watching this video.